Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for we probably go about 25 minutes today on Options Guide TV. We have had a good earnings season, relative. Last week we had kind of some mixed trades that we put on, and it was dependent on when you got out of the trade, if it was profitable or not. Options Guide TV is all about the setup of the trades. Obviously, we meet Monday, Tuesday, Wednesday at 11 a.m. Eastern time. So we expect you to trade in and out of these positions that are not meant to be a recommendation. But if you do put them on, you trade out of them, usually prior to the next show. We did one on Caterpillar, and I'm going to be fully transparent. I actually didn't do the skip strike butterfly when I got set up to do the Caterpillar trade. And I ended up doing a open wing bearish butterfly on Caterpillar. So I still kept kind of the bearish sentiment that we had in Caterpillar. And that trade is at basically break even right now. I'm hoping that we get a little bit more of a downturn. The reason why I changed my mind is, first of all, I couldn't get it done for the net credit that we could on the show. So I'm going to go through the Caterpillar trade, and I'm going to talk about the trade that we were talking about on Monday ahead of the Tuesday morning earnings report in Caterpillar. And then I'll just kind of show you the trade that I'm in right now, and I'm struggling with to try to break even. I really need Caterpillar to get below 430. The earnings report was very mediocre. They beat on a couple of numbers, and then they lost on a few more. Tariffs did come up. They're still a little nervous about it. Still don't have that transparency, and the stock can't really decide which way it wants to go, even though it's had a parabolic move to the upside over the last month. I really thought that this would be an opportunity for it to sell off a little bit, mainly because of the most recent move, if they didn't blow the doors out on their earnings report. And so this was the least expected move that I would have perceived, is that Caterpillar was going to go nowhere. As a matter of fact, they announced their earnings. Stock actually went down immediately after that earnings, and then bounced back, went up the next day after trading down after the earnings announcement, and then decided to just kind of hang around right where it was at heading into the earnings report. Now we're down 2 points today, or 0.5%. So let's start by looking at the trade that we talked about on Monday. Let's go look at the Caterpillar trade inside the Tradier Pro software. Here's the options grid that we have. Caterpillar at the time was trading fairly close to this. I think it was $433. So probably 80 cents above where this is at right now. And this trade has worked out just fine. If you got it done for a net credit of 20 cents, Caterpillar once again was at $433. We sold the near term August 8th expiration. We sold the 140. We bought one of the 455 strike calls. We then sold two of the 460 strike calls. We skipped the 465, and then we bought the 470. So if you followed Options Guide TV around our earnings reports, we look at this as an alternative to a short spread, not as an alternative to a butterfly. So we're selling in the short spread. We'd be selling the 465 and buying the 470, bringing in a decent net credit. But the way that I always build this skip strike, and part of the reason why I like to call it the skip strike instead of the modified or the broken wing, is that you are literally skipping that strike. And when you do that, you embed a credit spread that pays for the standard butterfly. That would only be 5 points wide. All right. So now the market opened flat. It was almost perfect for what you would want in this scenario, in that it opened flat. Volatility came out of the option contracts. It didn't go down, right? It drifted up. And ideally for the butterfly, for the skip strike, we made our 20 cents. It's pretty apparent that we can get out of this. Well, actually, we can close this whole thing for 1 cent right now. But I don't know why you would do that. Here's another benefit of the skip strike butterfly as opposed to the short spread, in that if the market starts coming back and actually finishes or actually touches 460 anytime between now and the expiration date, we could possibly close this for an additional net credit, right? It could actually trade for $5, which is the width of the long call spread in our strategy from 455 to 460. So if we were in the short spread, we'd just close it. We would have made 40 cents instead of 20 cents, almost double the net credit based off of the risk that we had. The risk wouldn't have changed. It would have been $5. And we would have made 40 cents instead of 20 cents, but we wouldn't have had a hedge in, right? And if the market came up and went against us in the short spread, you don't have time to react if it's a earnings catalyst gap opening event. That's why I like to do the skip strike butterflies as an alternative to either a short call spread or a short put spread, especially around an event like earnings. Okay, so you can get out of the trade right now, but if you're gonna if you're not gonna watch it, close it out and just take your 20 cents. That's the ultimate goal that we're looking for anyways. A solid $20 on our $500 worth of risk, depending on how many contracts you did or how many butterflies you did. It depends on your rate of return, but over a 1 week period, looking at about 4% on that. And then if the market comes down, and now it's trading right here at 431, well, that's making my butterfly look a little bit more interesting that I have on. I have a few butterflies on at 430 is my buy price. Okay, so 455, 460, 470. If the market comes back, we're quite a ways away from that right now. So I wouldn't be in a hurry to close this. And if the market comes back, let's go look at the what if calculator. Here is the butterfly. And you see here that the bend is important, right? In that every day that goes by, every hour that goes by, this is going to start drifting towards the middle. So right now it's saying we put this trade on for basically a penny is what I see. Yeah, $1 is the price that it grabbed when I sent it over to the what if calculator. Now, if the market comes this way, comes up this way, and time decays, the green line is going to drift towards the yellow line, and you could potentially make an extra $5. So there's no reason to get out of it. You got a chance. You got a chip in a chair to make a little bit more, but you definitely made your 20 cents. Okay. Now, here's the trade that I ended up doing because I couldn't get it done for 20 cents. When I went in to do it, I did it closer to the close on Monday, and I couldn't execute this for 20 cents, but that's what my screen grab was showing me. So I don't know if anybody out there did the trade and got it done for 20 cents. I'd be very interested to know. So I started to think about it, and I'm like, I'm a little bit more bearish on Caterpillar after that big run up than I thought I was. So I'm like, you know what? I wouldn't mind doing an open wing butterfly to the downside. So here's the trade, and I still have this trade on this position. 430, 420, 415. Okay, so we're down to 430. Nice. So the weakness is kind of building back in. 430, two of the 420s. 420s, two of these. And then I stopped short. Instead of doing the 410 would be the standard butterfly, did the 415 and bought that. And that means that we are long a put spread from here, which is worth 10 points. If the market goes against us, we are short a put spread, which helps lower the cost of our trade from 420 to 415, meaning this could make us 10. This would only lose us 5. So it's worth $5 if it goes below that. And that's the open wing. And I think, I guess I can just send it. Let's send it. Then there's no doubt that it's in the what if calculator. And I'm currently up a dime on the trade. I think I paid $2.05 for it on the close heading into earnings on Wednesday. I need this market to go below 430. We still got a few days. I might close it out at the end of the day, but if we can go below 430, time decay is my friend. And the market right now is at 430.68. You can look at it this way. If the market didn't move right now and we went to expiration, I would lose my entire $2.05, right? Because we're outside of the strikes. We're sitting right here at this point in time. Need it to drift this way, it could be worth $1,000. So I was risking basically $2 to basically make $8. I would definitely always, whenever I put these on, I'm never looking for a home run. So if I paid $2 for it and I can make $4 on it, I'm out. And so 100% trade is kind of what I'm looking for. Pay $2 to do $4. And part of the reason why I didn't mind this trade as much is because it was a Tuesday morning earnings report and we had a longer time period. So we looked at the skip strike butterfly. I liked the 20 cents that we could get on our $500 of risk, or $20 on $500 of risk. And I didn't mind that at all. But then when I couldn't get that trade filled for that, even though we saw it on in the show, the midpoint was trading there on obviously very liquid options. I decided that this is the trade I was going to do. And now the market has came back and helped me here. I was never down, 50% on this trade. And now the market is bouncing back a little bit. So this is a tough one, 197, 195. I'm going to have a decision at the end of the close today to decide if I want to take overnight risk with it. But I do think I will ride it until the end of the day, see where we're at, and either say, okay, I don't want it. I don't want the cheese anymore. Just let me out of the trap and try to get out at break even, or I'll let it run. I mean, we're right on the precipice. I just can't believe that Caterpillar, after that huge run up in the chart, announces earnings and the stock just doesn't move. That is the last. Like, look at this strong movement to the upside, and then they announce earnings, and now it's going nowhere. So in the short term, I do think that it's going to drift lower, but I don't need it to drift lower. I need it to go lower before Friday. All right. We're staying there. Got to go to the trading tab. Okay, now the other trades that we had on that I do want to look at. And if you, I see a couple of comments. All right. Good morning, Kurt. Follow along with the cat trade on Monday. And did you get it executed? Yeah, 26 cents. See, that's not fair, Kurt. I wanted to fill at 20. I was waiting to get filled for 40 and I never filled. Okay. Kurt got filled for 26. I would have taken 26. I would have taken 26 in a heartbeat. That's 4%. And that's kind of about the goal on these skip strikes. You have potential to make more. And if you do them, you do a 5 lot or something like that, you're making a decent percentage on the amount of risk. If you're just doing it on one contract, you're saying, well, I made, $20, but it's still on a percentage basis. It's a solid percentage basis considering it's only a couple of day trade. All right. That's good. That's good. Okay. So now the VIX trade. Okay. So I just realized that there is a new formula for the VIX, and I have to figure that out. I need to talk to Lex and see exactly what's going on with that trade, but I do like the concept of getting long the September VIX at this point in time. I still think the market's got a lot of choppiness ahead of it. The jobs numbers that have came out recently have added a little bit of just volatility to the marketplace as a whole. But the one contract that we did buy, let me see, I put it in the what if calculator. VIX long call is the 22 call. Okay, so right now that's about trading at close to break even, 173. I mean, I don't mind waiting a week or so. I don't know the exact plan because time decay is a big issue. The VVIX is 96. Okay, so the VVIX, the volatility of the VIX index, the VVIX, which tracks the volatility of the options inside the VIX index option chain, is at 96, which is kind of medium. Over 100, I think, is high. Below that, when we put it on, it was about 100. So I would pay more attention to this right now. I don't want to pay a ton of implied volatility premium. That would be 30-day volatility. And right here is a 42-day option contract. But the September, and we'll just do it with put call parity. The September VIX is 20. Yeah, it's pretty close to here. It's right around 20, right? So the call is $2.15 and the put is $2.30. And this is 2 in here. So it's right around 20. Maybe just a smidge below at this point in time. And that's where the futures is at. I'd always said that I really wanted it to get down to 19, but it just wouldn't comply with that before I got long the September contracts. But I'm okay with this. We're in the 22 strike that we were looking at, and I'm going to keep it on the radar. Okay, so that's just a quick review of it. We did do a short spread we talked about on Monday's show, but I'm not going to get into that one yet. We'll maybe look at that this coming up Monday after the weekend. Long 22 call with that expiration. Here is the short put vertical that we put on, hoping the market stays above 17 by the August 20th date. Now, a little bit different. This stock I do think is undervalued, and it's not getting the respect it deserves. PINS is announcing earnings after the close on Thursday, August 7th. So I want to get long PINS, and it's a fairly inexpensive underlying. The implied volatility is obviously high. So I just want to do a trade anticipating that they could have a solid earnings report. There's a little bit about the consumer that's going back and forth. The company is ran very well. Let's go look at the chart real quick. The last couple of quarters have been all right. Market came all the way back down, came all the way back up. Here's the most recent high at $40.88. We're staying above the 20-day moving average. We're kind of dancing around, hoping the catalyst would push us above 40. And then the next stopping point is 41 or so. And if you blow through that, you're doing pretty well. So I am going to just do a more of a 50-50 bet. We're going to go 1 point in the money, 3 points out of the money. We're going to buy this expiration. So you're going to have 1 day for this. You know what? We could do the butterfly. We could do the open wing butterfly. But let's look at this one. I'll give you 2 trades. We'll give you 2 options here. Obviously, usually put them on the Thursday, not put them on today, but we don't have Options Guide TV tomorrow. So we're going to buy this one. And then we'll go, that's 1 point in, and we'll go 3 points out, 39 to 42. And we'll sell that one and see where we're at. So we got 4 points. We're paying 172 with the potential to sell it for 4. So $2.28 is the upside. $1.72 is the downside. Send it to the what if calculator. And this is just looking for a bullish forecast on PINS, thinking that earnings could be the catalyst and it could drive us higher on the 1 day of the life of this option contract after that earnings report. Now, that is a very speculative trade, right? They're announcing on a Thursday. You have the Friday close. Let's compare this one to, let's look at our open wing butterfly. Well, I think we'll keep it at that same expiration. I wouldn't mind going out 9 days on it, but let's keep it the same. Okay, so then let's look at this as an open wing butterfly. Our risk will be 172, but obviously if it only goes down a point or it goes down 50 cents, we still have some value. Let's close this out and let's look at buying the 40. Give ourselves a little bit more upside. And I kind of think we stay at the 38. All right, we'll sell. We're making $2 there. Okay, so we'll sell this one. We'll bring in 80 cents. And then, so that's, now we got to go 4. We got to go 4. Let's go 4. Buy, sell twice, and then we go 2, 6, and buy that one. Okay, so this is 4 points and this is 2 points. That means 84 cents. Send to the what if. Okay, so a little bit lower risk. Yeah, man, I'm really into butterflies. The more I look at just bull call spreads and bull put spreads, especially around an event like this, the ability to sell that second option contract and bring in a lot less premium or pay a lot less premium is just I don't know, an interesting trade. I'm kind of selling myself more and more on these open wings as opposed to just a straight outright buy of a long call spread or a long put spread. So I think this is the trade where I would lean. 80 cents. You needed to get to $40.80 to break even. You have 1 day remaining, so the time value is going to come out of this trade as soon as you do it. The fact that they're announcing on a Thursday makes this butterfly a little bit more interesting, because if you're correct on your forecast, you need all this premium, the 61 cents of premium, to go away as quickly as possible, and that will happen because you're announcing on a Thursday. You're looking at 179% implied volatility. That's going to come crashing down, probably land somewhere around that 60% level. So yeah, this is the trade. This is the trade. Now, if you want to give it a little bit more time, here's the thing about the butterfly. You need this option contract to go away as fast as possible. So obviously speculative to only do it 1 day. We saw that in Caterpillar. Caterpillar, drifted higher and now is going lower. And my trade might end up panning out because I had a few more days. We're in this trade. I like this. I like I'm going to say this is the official paper trade. This is the one that we're going to look at. 84 cents. Pins has had a solid, net margin. They've been a very well-run company. Stock's been beaten up a little bit speculative, but, eBay had a solid earnings report this time around. Google or Amazon's in a little bit different world because they got a little bit of cloud numbers that were going on. But I think that bodes well for a well-run company like Pinterest. All right. I think that's it. 11:26 right now. So thank you so much for popping in. This will be the official paper trade for this Thursday. We're getting to the end. We're getting on the tail end of the earnings. We still got a lot coming, and especially because NVIDIA is still out there, right? I don't think earnings season is done until NVIDIA posts. But with that said, interesting trade in pins. I will probably put this one on, and I think I will lean towards our open wing butterfly strategy, much the same that I did in Caterpillar. Thanks for stopping in. We'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.